And I think an important factor that you just brought up there, I know for a lot of people, if things were to go from interest only, if repayments were to go from interest only to principal and interest, that would drastically affect the serviceability. That would drastically affect a lot of people's ability to continually pay down that loan or to service that loan. In your experience, and this is something that we both deal with, but as a discussion point, when you hit that 5-year period, if you have an investment property and you've hit that 5-year period of banks knocking on the door saying time to roll over to principal and interest, what kind of options do people have available to them to keep that at interest only and try and keep those cash flow costs down as much as possible?
So really good point. And I use those examples theoretically because theoretically that is often the best way to go. But in reality, a bank, if you have an interest only period, a bank will then have to assess your serviceability on 25 years to nil.
So effectively, it's the same loan. They've just shrunk what's normally the 30-year loan period down by 5 years because you haven't touched the principal in that 5 years.
This is in their servicing calculations.
Yeah.
For everyone playing at home, that's what we're talking about. Actually, in reality, you will have to service it over 25 years to nil because that's the loan term if you can't refinance it in that period. But as you start to build a portfolio of assets and you become a somewhat more sophisticated, this becomes your business. And business lending, terms on business lending is often 2 to 5 years. Sometimes some people do it for 1 year business lending. And what I mean by that is that banks will assess your ability to service the asset for those 2 years interest only. At the end of the 2 years, you then need to reservice it again. So, starting to move into that next category of an investment, but you kind of only get to that category when you're sort of 5 mil plus. So more the message being to most investors is if it is an investment asset, try to have as long an interest only period as you can. However, on an owner occupied property that's non-deductible, the recommendation and the strategy would be let's pay that off as quickly as possible.
Mm-hmm. Yeah, absolutely. And I think we've talked about features such as the offset, and we've talked about things like whether you have principal and interest or interest only. What other factors of a mortgage can really impact your ability to scale and grow your portfolio? So if we put aside the interest rate, which is of course one of the first and foremost things that you look at and pay attention to, what are some other levers you can pull to make future vision more favorable to you as you're trying to grow your portfolio in terms of mortgage features?
Think of a bank as an investor. The bank is investing in you. It's providing its capital to you, or it's providing a capital to an asset. And all investors look for cash flow. That is, cash is king. So it wants to be able to see that you've got, you as a sponsor have good background of repayment history. That is, no red flags on your servicing record. You don't have lots of little credit cards and loans because that the bank suddenly says that you're not very good at managing your cash flow. It wants to see that you have taken out debt previously and you've either paid that down or paid that off. I mean, these are things that are around the edges, but they're important because they build that whole sponsor profile.
Because at the end of the day, this is about trying to find a process that you can reproduce.
Correct.
So I think there are a number of adages. The first property is always the hardest to get into, but I'd actually posit that the second one is almost harder because I think the landscape of lending and the landscape of what gets taken into account with that serviceability has shifted quite a lot, but certainly over the last decade or so, and certainly in Australia, where if you are able to generate enough equity as a deposit, you're able to get into some kind of asset. But once that's plugged in and the banks take that serviceability into account, and if your income, or as you say, cash flow hasn't moved proportionate to that, your ability to buy the next one, it is often quite a bit more difficult.
Drastically impacted, yeah. And so back to your question about what you can do is you can review that asset. You look at that purchase you made and say, okay, am I getting the best cash flow? If not, then what can I do to increase that cash flow? And does it make sense to actually throw more good cash after this asset, or am I throwing good cash after bad? And actually, it's not going to increase my returns by perceive it to. There's a natural depreciation in a property. There'll be, no one wants to rent a property that's falling apart. So you've got to actually look after the asset as much as possible, which then increases your yield and returns. And that message I was trying to give is cash is king, being the more you can generate out of that asset, or you as an individual, will increase your ability to increase the term of this if you want to do as an interest only period, or then use it to flip into a new investment.
That's right, yeah. And I think that platform effect, or the stepping stones, is probably worth its own topic. So stay tuned. But I think the people's journey of, okay, I've got my first property. The bank sees me in a certain light in terms of my serviceability and my overall income. I think the topics that come to mind are sometimes the bank's calculations for what rent or what income that asset can yield in addition to your own can be quite obscure. I think people can do their own calculations of saying, well, if the interest rate is 5% and I've invested very well and in a high growth area as well as a high yield area, let's say I'm getting 5.5% or 6% yield on that asset. In someone's mind, you would definitely understand them thinking, well, I'm positively geared. Surely the bank will see that and say, well, have some more money, you can invest again. And I think that might be a little bit different in terms of banks' calculations, where it might be a slight mismatch in terms of what the paper would suggest versus what the banks take into account. Is it worth explaining a little bit about how banks actually calculate serviceability with things like rental yield or income versus your serviceability and your ability to do it all again and get another asset?
Yeah, absolutely. And I'd love to know where the area
where the 6% are.
Yeah, the way they calculate it is to think about it, remove you from the equation. That is, you've got your own personal income, expense profile, and whatever comes with that. But if you think about that investment on its own, you need to, and this comes whether you're a multi tens of hundreds of $1 million asset, it's the exact same process, which is tell me about that piece of paper, which is the lease document, and tell me about the profile of the parties inside that lease document. And they start to get into looking at the weighted average lease term. So, if I've got one client who's got a 25-year lease to a Global 200 company, that's a piece of paper you can trust, because that Global 200 company it's got a bond rating by several bond rating agencies. So that piece of paper is going to be good. But then if I've got another piece of paper, which is you're on a month-to-month, yes, you may be paying 5-6%, but what do we know about Joe Bloggs? Is Joe Bloggs, what's the profile of Joe Bloggs? And so the bank will look at that and they'll say, well, yeah, you're getting 5 or 6%, but Joe Bloggs can move out tomorrow and you're stuck, and you've got to then try and run a leasing campaign and pay new leasing fees and costs to the agent. So yeah, just thinking strategically about these and having really good tenants is critical, and that comes from having good property agents, and being in that good growth area. Often good growth area attracts good tenant profile, and the ability to sign, if you can, longer leases. I know most residential leases, people don't want to go over 12 months as a term, which the banks understand. But yeah, more the message I'm trying to say is just think about that piece of paper and anything you can do to increase the profile
stability
of that,
and robustness of your earning capacity.
So sometimes you need to actually split bank and use those tools in the market, and that's where we come in and we can sort of guide and direct you as much as possible. James specializes in consumer lending, and so the ability to then understand where best to receive the lowest interest rates and get the highest limit is definitely something you need to talk to your mortgage broker about.
Exactly. And all those features that we've been talking about, whether an offset account is the best fit for your strategy, or whether it be interest rates being the highest priority, or whether your long-term vision of being able to purchase multiple properties and what that would mean for the areas that you're looking at, the potential yield from each property, and how banks take into account those different revenue streams and how much they would be willing to loan you at any given point. They're all mechanisms that come into play when deciphering how to best set you up with the best fit for purpose mortgage setup. And I think part of what we absolutely do and emphasize is not just understanding the immediate purchase intentions, but trying to understand what the broader objective is. And for a lot of investors, it's a huge milestone to get the first, but an even bigger milestone in some circumstances to get the second, because you go from I bought an investment to I'm an investor with a long-term vision, and setting up the mortgage to enable that and provide insight to you in reaching those objectives, I think is part of our core business and something that excites us, because it's always a little puzzle to work out and make sure it is tailored to that person's strategy.
And just to show where this can go, a client of mine, they've now got their 60th property. And so all they've done is the exact strategy we spoke about. Use the bank, have tax deductible interest, the property increases in value. That, mind you, they've got a very good operating business that they use the tax system and the negative gearing capacity to, the operating company really supports all the debt for the property assets. And the property assets in their own right won't be able to service the obligation, and that's where the operating business or that cash flow comes in. But they know over time, if they just keep their debt levels where they are, in 10 years time, that all those property assets will double, and yet their debt levels will remain the same. All they have to do is just service the interest in the interim. And it's a really effective strategy in building long-term wealth for families.
Absolutely. And I think that will stem into other topics for other episodes, where we can talk about how do you then pole vault from the first to the second all the way to the 60th, and what does that look like in terms of income. A topic that I'd love to explore in subsequent episodes is the knowledge base that currently exists. If you go to any sort of bookstore and pick up the likes of Rich Dad, Poor Dad, and a couple of other fundamental real estate investment tools and pieces of tuition, how that knowledge relates to the lending landscape nowadays, and if that's shifted overall. Because I think that will definitely influence people's wherewithal and ability to reproduce that process.
Yeah, let's note that down for the next couple of episodes. But yeah, amazing discussion. What key insights for you from the discussion, James?
I think, as you mentioned a couple of times, cash flow is king when setting up your portfolio and making sure that you're putting yourself on good footing for the future, and understanding that there are multiple levers that you can push and pull in setting up a mortgage to make sure that it's supporting that vision and that objective.
Amazing. Key insight for me was what James spoke about, being first one's hard, but sometimes often the second one's even harder. And the second thing is the right strategy around, is the product the right fit for what you're actually trying to do to set you up for long-term success and building wealth for you and your family.
Absolutely. See you in the next episode.
Thank you.